Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
This is our final session of the day, but I think it's going to be a fun one. We did this one last year, and we had great feedback on it. It's our ETF Spotlight Panel. So we have a panel here of industry experts, which I will introduce as we go along. We're going to give them each about 5, I know Larry's going to take 7 minutes, to give us their pick for the ETF they think that you all should add to your watch list for this year. And then at the end, I'm going to ask for some audience participation, and we're going to vote with our applause for the winner, who's going to get a very nice bottle of wine. So stakes are high. Before we get started, I'm going to let you know what my pick is. My pick was sort of stolen by Tony earlier, but it's ZGLD. It's our BMO Gold Bullion ETF. I predominantly invest in asset allocation ETFs, but more recently I've added a small position in gold, a great diversifier for the portfolio, especially during volatile times. And as Tony was mentioning, at a 23 basis point MER, it's a lot more convenient than, going to Costco, buying the bars, and digging a hole in your backyard. So I think that the ETF vehicle for gold is a great invention. Let's kick it off. Ladies first. Valerie Grimba joins us from RBC Capital Markets. She's the Managing Director of ETF Sales and Strategy. Val is also a market maker. So we actually had an episode last week on Market Insights where she went into great detail of her role as a market maker and how she supports the liquidity of our ETF ecosystem. So check that one out. But Val, over to you. What's your BMO ETF pick for today?
All right, great. Thanks, Erin. Yes, so I sit all day long on the ETF market making desk. We're out there all day long on 1,000 ETF tickers with bids and offers, and we kind of cover the whole gamut of securities that you can put into an ETF. And why should you listen to me, first of all? I've been in the market for the institutional space for about 20 years now. And I talk all day long to institutions, that's hedge funds, pension managers, large asset managers, and we talk to them about what ETFs they should be using and how they should be trading these ETFs. And so, Erin, that was a perfect segue because my ETF that I'm going to recommend, again, is a democratization of an asset class that previously has been very hard to reach at an advisor level or a DIY level. And that is ZA, or ZAAA. I like to think of a ZA because I love pizza, so you can keep that in mind for later. But it is providing access to AAA CLOs. Now, you might be thinking, Val, doesn't this sound a lot like CDOs, which kind of triggered the global financial crisis and brought down everything that came with it in 2008, 2009? Yes, except there's one very different letter, and it is much different below the surface. So, collateralized loan obligations. CDOs are collateralized debt obligations. CDOs held things like subprime mortgages, and it kind of became a bit of a house of cards. CLOs hold leveraged bank loans, and these are corporate loans. So these are companies that are going to a bank, and that bank is providing that company with a loan. And typically, these loans are not investment grade. That means a few things. Yes, they're a little bit more risky, but yes, they also pay you a much higher yield. So you're going to get a significant uptick in yield. And like we say in finance, there's never free lunch. So that's kind of the trade-off. But CLOs come with this really cool, nifty financial engineering thing called the securitization. So these banks package up all these loans and they break them down into different tranches within the CLO. So there's going to be the lowest rated tranches, BB to BBB, single A, AA, AAA. So we've got this capital stack here. And AAA is at the very, very top of that capital stack. And what that means is that any losses in the loan portfolio will get absorbed by the lower tiers within the CLO. So as a AAA CLO holder, there has to be a lot of losses or impairments at the bottom of the structure before it hits AAA. And in fact, CLOs have been around for over 30 years, so that's through the GFC, through COVID, through the last few weeks of market stress, and there has not been one default in the AAA CLO level. So what that means, it would take so much duress, like almost catastrophic levels, for the AAA level of the CLO to feel any kind of pain or stress by default. So summing that kind of all up is you're going to get a really nice pickup over a floating rate. So what that means is that the CLO pays you a yield on top of SOFR, which is the overnight rate. And what this also means is that it resets quarterly. So every quarter, it's going to reset. And what that means is you're going to take on very low to almost zero duration risk. The duration is going to be 0.25 years. That's the quarterly reset. And what that also means is if we think we're going to a period of volatility on the rate market, that having low duration keeps you somewhat insulated from that. The other last thing I'll leave you with, I don't know how I'm doing on time, but it also is a diversifier within fixed income portfolios. CLOs have been very low correlation with other fixed income products. And again, just providing democratized access to something that was only available to big institutions before the ETF structure.
Amazing. When you told me you were going to do this product, I said, no way you're going to be able to do that in 5 minutes, but you've done it. This product was just launched a couple months ago or a month ago. So we won't have the performance visible for you, but you can check out the website and find out more information.
I will, Sarah, I just say, I had the chart up. I was talking to a client on my Bloomberg, and one of the equity traders turned around after my call and he said, what chart did you have up on your screen? Because if you look at it, it's left to right, straight up, and that's a reflection of rates moving higher. But take a look at that so you can understand kind of the track record of the product.
Okay, a great one to add to the watch list. Next up, we have Tony Dong. Tony, we've already introduced, but he is an author for publications like The Motley Fool, The Street, and many more. And he's recently launched his own website, etfportfolioblueprint.com. So make sure you check that out. He's an ETF expert. Tony, what's your pick?
ZGI. So just a question out here. How many of you own Enbridge in your portfolio? Come on, there's got to be more than that. You guys like Enbridge because of its high dividend yield, likely, but there's a lot of structurally attractive things about the nature of its business. For instance, 25-year contracts with many of its clients, insulation from energy prices because, well, these are fee-based contracts for moving natural gas and crude oil through its pipeline. Now, what if I told you there was something like Enbridge, but far more diversified and not limited to a single North American pipeline operator? That's ZGI. When you think about the assets that ZGI owns, we're talking about regulated utilities, pipelines, airports, water utilities. These are things that are heavily underrepresented in normal indices like the S&P 500, where I think energy only comprises about 4% and utilities around 4% too. So this is a way for you to access an asset class that most institutions are heavily involved in right now. For instance, the Canada Pension Plan, CPP, fantastic money managers, excellent long-term risk-adjusted returns. And one thing you might not know is that a significant portion of their portfolio is not in public equities. It is in alternatives. And a big portion of that is infrastructure. CPP loves going out there and buying stakes in airports, buying pipelines. And by doing so, they are purchasing the rights to those contractually obligated cash flows that these assets generate. It provides somewhat of a stabilizer, but more importantly, inflation-linked incomes. Everybody remembers what happened in 2022 when rates and inflation rose. Well, ZGI, along with many of these infrastructure-like ETFs, tanked that perfectly. And I pitched this one last year too, and since then the price is up 16%, and that's without even factoring the dividend yield, which is actually really quite nice because, again, the underlying businesses in here, every quarter they're moving that gas through, they're delivering electricity, they're having airplanes land at their facilities, and every time that happens, a monetary transaction occurs, those cash flows accrue and flow to you because a lot of these entities have very favorable shareholder return programs in place. They increase those dividends every year, and opportunistically, they will buy back their shares. The problem with infrastructure is that unless you're a big money manager like CPP, it is really hard to get access to the best deals. And more importantly, not a lot of these are liquid in that it may be years before they are able to exit from their investment, before they get an opportunity for an exit. But with something like ZGI that is exchange listed, where it benefits from the creation and redemption in-kind mechanism of the ETF, where when you're buying this, you can be assured that the price is going to be very close to the net asset value. That kind of liquidity is unparalleled. You're not going to find it anywhere else but in the ETF structure. And, Valerie talks about democratizing access to asset classes. CLOs are the latest one. Infrastructure was one of the first and is one of the longest lived. And when I talk about adding an ETF as a satellite allocation in your portfolio, you want to make sure that it doesn't overlap with the rest of your portfolio, right? You can use a variety of tools online. BMO has a few, but if you check the portfolio overlap between ZGI and something like your asset allocation ETFs, it's actually quite minimal. And if you look at the correlation, this ETF has a history of zigging when the rest of the market zags, because once again, it is more sensitive to drivers of inflation. The mechanisms that make the companies in this ETF earn money are very different from, say, a tech company or a healthcare company. This is just one of my preferred tools for gaining exposure to what is otherwise, again, a very hard to access asset class. I'm sure many of you like the idea of owning real assets, but you don't like the illiquidity that comes with it. This is, in my opinion, a tool for doing so.
Thanks, Tony. Infrastructure, a hot topic today. Moving on. Bipan Rai, welcome back to the stage, our head of ETF and alternatives strategy. Bipan, what's your pick?
So we had ZAAA, ZGI. Both of those are actually two of my top picks. So that's the downside of picking last, I guess. But, so, here we go. So, yes, the official title is Head of ETF Pick Alternative Strategy. But my prior late, I was a bond guy. I was bonding at Borrow Stage person. So, spent a lot of time in the foreign fixed income market, in particular when it comes to paid corporates.
One of the problems I kept running into is the fact that, when you invest in a single bond, you're not getting the same sort of advantages through diversification, say that, you would in say, an ETF. At the same time, though, a lot of ETFs that track fixed income instruments, not really, they're tracking underlying indexes as opposed to acting like a bond-like instrument. And so the beauty of the BMO Target 2029 Canadian Corporate Bond ETF, it's a target maturity bond ETF, is that it gives you the liquidity of an ETF. So it trades like an ETF. It's diversified like a fund, but it matures like a bond, right? So basically, this is a particular ETF that's composed of a basket of corporate bonds, right? All of them have the same maturity in terms of years. Now, what's interesting is what happens in that final year, right? Now, there are competitor products out there. I'm going to tell you what distinguishes their product from ours. So, at the end of the longest corporate bond, when it matures in that final year, the fund shuts down. It's terminated, right? And you get that internal rate of return, okay? The problem is you have a basket of corporate bonds maturing at different points in that final year, right? So what happens to those bonds that mature before that longest bond matures, right? They get reinvested at the money market rate. Now, you don't need me to tell you what the obvious risk is there, right? What if in that final year, interest rates move lower? All of a sudden, those bonds that are maturing in that basket are reinvesting at lower rates, right? So you're not actually getting that internal rate of return that you expected to get when you bought the bond at inception. We've solved for that problem using this particular ETF, right? So we are locking in at a forward rate, and we are locking in at an IRR that basically is set in stone for the duration of this particular ETF to when it matures, okay? If you look at the backdrop, and you heard me talk about this earlier with Amber, right? I am worried about the direction this country is heading over the next couple of years. We are going to go through a period of economic pain, right? Right now, I look at the way the bond market is priced in the Bank of Canada. If we look at forward OIS, I believe the terminal rate that the market has the Bank of Canada settling at is probably around, 2.25%, maybe 2.5%. So we're talking another cut or two. But what if the economic damage is actually deeper? What if tariffs and trade policy change materially, and there's more damage inflicted to the Canadian economy than we expect, and stimulative fiscal policy isn't enough to address that pain? Well, guess what? The Bank of Canada is going to need to cut by more than what the market is pricing in, right? The reason why I bring this up is, if that is the case, then we are talking about a structurally lower neutral rate of interest for the Bank of Canada that the market is not pricing in right now. And that means by the time that we get to that final year, where the different corporate bonds are maturing in the basket, you are exposed to a significant degree of reinvestment risk. This is a product that potentially solves for that. Right? So, you might be thinking, okay, well, what if you're wrong, right? And of course, I'm a macroeconomist, I'm a strategist, I've been wrong many times in my career. I'm not guaranteeing 100% of a hit rate. What if you do get higher yields in that final year? Well, the beauty about a product like this is, okay, fine. If you are in an environment where you see higher yields, you can liquidate this particular fund well in advance, take your money and reinvest at those money market rates anyway. So you get that flexibility. While at the same time, you are locked in with respect to a floor in your IRR for this particular ETF.
Thank you, Bipan. I think that's a great pick. I really like BMO is, if you're not aware, #1 fixed income ETF provider in Canada. We have an excellent lineup of ETFs, and this is just one more innovation in the quiver. And I like that we took our time. We waited for the competitors to come out with the product. We listened to investors to figure out what are the pain points, and then we launched. So thanks, Bipan. Last but certainly not least, Larry Berman. Larry is founder and CIO of ETF Capital Management. You'll also recognize him from his BNN show, Berman's Call, one of the #1 rated shows on BNN. And Larry also has a YouTube channel where he shares his weekly market updates, so I encourage you to check that out as well. Larry has over 36 years of experience in the industry. So Larry, what's your pick today?
It's actually 39.
Oh.
So big shout out to the gray hairs in the audience. So why should you listen to me? It's because I have experience relative to my younger friends here. No, strategic in going last. And a big shout out to the guys before, because they're the next generation of public educators. Having been on BNN and, since the very first day, literally, they were on the air. And doing my show and trying to educate Canadians about making a better investment decision. So I'm going to talk today about making a better investment decision, or how you can go about doing that. The most gray hair in the room is Warren Buffett, stepping down this year. He said, don't buy Berkshire Hathaway, buy the S&P 500. Like, when I'm gone, no one else can do this. Just buy the biggest and best index in the world. You benefit from survivorship bias, et cetera, et cetera, et cetera. All these ideas are very, very good. All of them, without exception. They were really well explained, but they're this much of your portfolio. If you put more than that much in ZAAA, there's some considerations. Infrastructure, great, but if you're a growth investor, it's not going to give you a lot. And as a former bond guy as well, great pick. But again, how much is that going to be of your cash wedge? So this is your core. And so what I've put up here is an example of ZUE, which is S&P 500 currency hedged. By the way, if your call on rates are right, we're going to $1.50 on the Canadian dollar. So you got to make sure you get the currency call right, too, when you're investing globally. So that's a big part of it. So you could have ZUE or ZSP, depending on do you want that foreign currency exposure or not. But these ETFs that are have these collars on them. They're managing risk. People have been calling into Berman's Call into the 19th year now. And the essence of every question is, should I buy this now? And what that means is everybody asking the question doesn't know what to do, or they're looking for confirmation for something they're already doing. So I've been at this a while. I was the first person in Canada to have a CMT and a CFA, so an expertise and a certification in technical analysis and fundamental analysis. And in my 39th year now, I don't know how to time markets. It's very, very hard. It's impossible. Warren Buffett says that all the time. But these vehicles that we're showing on the screen here, ZBAL and ZCon. So ZCon is conservative portfolio, 60% bonds, 40% equities, well diversified globally. Great. It's got a certain risk profile. ZBAL is 60-40. Again, your traditional balanced type portfolio. And those are great for the vast majority of people, but here's the problem. Bonds are broken structurally for a long time. We've got inflation to be concerned about. We haven't had to be concerned for 40 years. I think traditional fixed income, there's no term premium. So there's a great example for you guys seeking extra yield. It's 50% of the world index. Okay? So here's the thing on how to use these. When you're unclear, you're unsure, you think there's risk, but you don't know how to time it and you don't want to go to cash, use one of these buffer ETFs, whether it's Z April, Z October, Z July, Z January. They're quarterly rebalanced. And they give you a cap. They sell a call to buy put protection, to protect an amount of portfolio. And what it ends up doing is giving you a risk profile like a balanced investor, but you're still 100% exposed to the benchmark in the world. I love that for everybody. I don't care how old you are. But here's how you use it. Because after a correction of 20%, you don't want to be giving away the upside. You want it all. Right? So when the market's correct, you want your ZUE or your ZSP, depending on your currency view. And when you feel the markets are uneasy, you don't need to go to cash. You can stay invested and get the protection that you would need from that balance that bonds will not give you anymore unless you're using Z AAA, okay, by using one of these. So in taxable accounts, you've got to consider the tax part, but in registered accounts, all day, all long, flip back and forth, change your risk profile in your portfolio without having to use fixed income. It will serve you well for decades to come in this very uncertain world of valuation and of inflation considerations, etc.
I'm impressed. You did that in 5 minutes, Larry. Very nice.
I practiced so much last night.
Okay. Okay, I will save time for questions, but let's vote on our best pick here. What do you guys think? Who had the best pick? I'm going to go down the line here and vote with your applause. So Val had Z AAA, the new CLO product. You guys are going to make this hard for me, I know. Tony, infrastructure, ZGI. Bipan with the target maturity bond ETFs. And Larry, which I don't even know what to call your pick, ZUE/buffer ETFs.
Yeah, let's do.
Okay.
I'm a 2-year-in-a-row defender. There you go. Thank you very much.
Really? Does Larry need another expensive bottle of wine? Right?
I was also going to say...
But my wife does.
Since this is year 2, we should put up how our picks have performed, because I don't know if ZPay actually performed as well as my pick did last year. So I'm just going to put it out there. Like, I put the performance on the record.
Let's do it.
Yeah.
Maybe we'll start with that next year to give
good.
some credibility.
That's great. Next year we'll do that.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.